Currently co-founder of a stock screening and quantitative trading portal with features to screen, analyze and backtest the listed stocks on the Indian stock market. Mr. Kora Reddy will be our expert and the speaker for the next session. Can we please call him on stage and have a huge round of applause for him?
So what I would be talking is basically just to give a little bit of how a quant guy mindset works when it looks at the open, high, low, close and volume of a Sensex or any index. Just a brief introduction about me. So actually that's my LinkedIn profile. You can search for Kora Reddy. I'm actually the author of this book, wrote about like 3 years ago. It just gives you a glimpse of how to approach for quantitative trading patterns or whatever. And currently I am a co-founder of a startup company in US, which is basically the PastStat, which gives you the quantitative screeners. So this is briefly what I would be talking. So I will just briefly give a 15 or 20 minutes introduction of what are the various parameters into the backtesting and what should you be looking at when you are trying to backtest any pattern or any trading strategy. And it's little, I won't say it's difficult, but it's impossible to track all the patterns that what goes in every mind. So it's just like I would try to give you like few ideas so that you can build based on top of them. And perhaps some like few patterns if we have like time or whatever that I could operate on Excel sheet and then show whatever the current, some of the edges that I try to fiddle and play with on a day-to-day basis. And that's basically the motto. So you just like try to feed the brain so that the people will pick up their own way of looking at the patterns. Like give a man a fish and you feed him for a day. But if you teach him how to fish, he can, you are feeding him for a lifetime. This is the the basic question, like which, like I mean, at least for me, that's the question. That's when I entered into this testing or quantitative world. So this is, I don't know how many people have heard this name called Victor Niederhofer, and he writes a couple of books. One is The Education of Speculator, and the second edition or whatever the extension to that is Practical Speculation. And both the books, the theme is, okay, have you tested that? Whatever anybody talks, you would be seeing most of the people on TV or in your circle or anybody saying, oh, the market is now above 200-day moving average, or it's fallen like 1%, or so many theories, like RSI now is above 70, it's like overbought. These are all theories, but have you tested and then seen what is going to happen the next? Like whenever RSI is greater than 70 or whenever the market is above 200-day moving average, what's your probabilities for the next day? So that's the premise. Look, have you tested whatever the hypothesis that you want to, whatever you are like looking at the current market condition? And most of the times, I don't use a fancy software like very, what do you call it, the complex technical indicators, which basically even the author of the indicator himself wouldn't have known, okay, what are the steps to do it. For example, I'm like, I don't know how many people can calculate ADX by hand. How many people here can calculate ADX by hand? ADX period 14. If I give you like 28 points, you can calculate by hand. ADX. Yeah, so I don't use the complex technical indicators like that, which basically requires so many loops or whatever, that complex calculation. The reason for that is whenever I look for a patterns, I don't want to write probably like 5 or 6 lines of code, or I'm like, want to be as simple as possible and try to find. And that's one of the reasons that I use Excel, because I know exactly what I'm trying to do. Not somebody else proprietary indicator or like complex indicators which he which I don't understand why it is developed or what is the philosophy that it is developed with. Okay, when doing any of the back testing, so these are like very simple and the most important factors that I look for. Of course, beyond this, I also look for so many other factors, but these are like, okay, something to start with. These are like sufficient whenever you are doing any back test. One is the number of years analyzed. This is, again, so any of these theories, especially in the stock market, there is always a for argument and against argument. That's the theory in the stock market, unlike in any other educational fields. Something like doctor, if, okay, you have a fever, okay, take paracetamol, that's it. All the doctors will say the same thing. Whereas if you go into the market, okay, that's how it works, but disclaimer, it may not work or whatever. So every topic has, or every statement that you make has a pro and con. So coming to the number of years analyzed, yeah, preferably for indices, or if I'm looking or trading at the index, I at least want like 10 years of data, and preferably like a cycle, again at least in the retrospective basis, like up cycle or down cycle. So Indian markets do fit that, and of course because of this 2008, 2000 burst, and again up, and again 2008 burst, and now again the current up. So you like get two cycles in most of the international markets. So yeah, I mean, if you go back, like 10 years is what I prefer. And when it comes to the stocks or something like that, okay, I look for the recent regime, or like preferably I try to keep it as short as possible. Something like 4 years is what I prefer when it comes to backtesting on the stocks. And the second thing is percentage of winning trades. This is it's just like your comfort factor. I mean, so especially when I'm in a short-term trading where my positions are held only for a day or two, or at max 5 days, I want that number to be as high as possible, because I mean it's not only the what do you call it, the capital required or whatever, and also the confidence and the money that I can churn in and out, because I would be placing more and more trades. Whereas the trend followers, they can get away even like, let's say even 30% or 40% of the winning trades. But when you are like highly leveraged, you cannot get away, because let's say you hit a stream of 15 losses or 20 losses when you are doing that. So that's the reason I prefer my percentage of winning trades to be at least 75% or 70% plus, because I'm like looking at like 1 day or 2 day swings. And the second most important is average profit per trade. So this is, I mean, it should at least serve your costs being the buy and hold from 2000 to today on a Sensex would have given you about 3 basis points, that is like 300th of a percentage point. That's like approximately like the market has moved like 22,000 points and divided by 14 years, that's like 3,300 days. So you are basically getting about 6 Sensex points on average every day, which translates to 0.03%. Plus you have your transactional costs, you have your SEBI charges, like 3 or 6 other various charges. So at least if you make them up again, it will add like, let's say double or whatever. Like, so just by simply buy and hold, you can actually get like about 0.05% or 5 basis points. And when you are doing a back test, you should at least have that 5 basis points plus. Otherwise, just like wastage of doing the story, wastage of your time, and probably looking into further into any of the other parameters. So for me, yeah, personally I prefer at least 0.5% if it is for a day. Otherwise, yeah, it doesn't really make sense for me to test the strategy or deploy the strategy in live. As many of the people know, I mean, that typical math joke, right? So like the average of 5 people is about 1.5 meter or 150 centimeters, whereas the lake depth is, let's say, 150 again 150 centimeters or 1.5 centimeters. So now all the people decide, okay, we can cross, but there are like, the average would have come because one guy is like about, I'm just giving a vague example, like 3 meters and all other guys are 1 meter. The guy who is like 3 meters is the one who can pass, whereas all other guys get drowned. That's the problem with the averages. So 1 or 2 numbers can skew your entire stuff. So that's the reason you look at median. If your number of trades, winning trades is more than 70%, your median should probably be on the positive side, or like as close as possible to the average. Whereas for the trend followers, because they only make these 1 or 2 blackbuster trades, like crude short last year, that's like a difficult trade to make. But again, so if you had made that one trade and if you had even had like 9 instruments lost, you could have made up your money in the last year. Your median obviously will be low because you are looking like 1 or 2 blackbuster trades. But when it comes to short term trading, like probably a day or a few days holding, I want median to be in positive side. I am particularly not bothered at all on the largest winning trade in historical data because I am pretty much sure that is not going to happen again, at least because I want to be as pessimist as possible when I am testing or believing a strategy. Whereas on a largest single losing trade, this is what I want to concentrate. So if I have done some back testing, okay, let's say a largest losing trade would be like 3% of the trade. Okay, can I take that 3% of the loss in my future or live trading? Or rather I would say like, okay, prepare at least for twice the largest losing trade in your historical results. Or even better, you could create something called a fudge loss or fudge factor. So what this is like, what is the largest move in Indian markets in any average, in any absolute direction? Sorry? On a single day? Yeah, that's on May 19, 2009 election results. So the move was about close to 19% or 20%. So that is the maximum absolute move, and it's possible, it's not possible. Yeah. Okay. It's definitely possible that 50% of the people on that day or at the close order would have been short and would have been long. So prepare, you also could prepare, okay, how would I behave or my strategy would have gone wrong and I would have been like 20% loss. So how would I have behaved? So that actually gives you little clues to your position size. So I would concentrate mostly on more on largest losing trade rather than the largest winning trade. Now these are little important factors. So one is the profit factor, which is basically the dollar amount, the total dollar amount you have won on your winning trades divided by the money which you lost on the losing trades. So for example, let's say you made 200 trades and 100 trades are winning and 100 trades are losing, and your 100 trades would have given you like 20 points on a 20 Sensex points. That makes 20,000, sorry, 100 into 20, that is about 2,000, whereas your loss making trades on an average lost about, let's say 10 points, that's like 1,000 loss. So your 2,000 divided by 1,000, that is your profit factor. I would prefer this to be at least 2 or 2.5, and up on the optimistic side. But again, if it is like too high, like let's say about 80 or 50, there are some strategies which you could create, which I will show you, but that would be like little on the lucky side. So preferably like 2, but not go beyond like 10 or something like that. But again, that's your choice. But if the profit factor is dropping less than 1.5, there's no point. You could as well gone and bought a buy and hold strategy, because your transactional costs, your whatever, the trading costs, will not let you on a long run any profit or anything. So make sure that it's like more than 1.5 or yeah, make sure it's more than 1.5, preferably around 2, 2.5. The outlier adjusted profit factor. As again, so the same day when the Nifty was up by like 500 points, so the Sensex was like up by 1500 or 1700 points on that day. And if your trading strategy has caught like 1 or 2 profits like that, so obviously your entire trading strategy profits are coming from those high or maximum winning traders. So it's better to remove them and again recalculate. How many you remove them, that's again a choice. So preferably I would like to remove 5% of the number of trades that the trading strategy has generated. Suppose you have 100 trades, so the 5 largest winning traders I would remove and then recalculate the profit factor. Or at least remove the topmost and then recalculate. That's the easiest thing to do. You could also adjust, yeah, I mean the next thing is like 5%, and then you could again apply your standard deviations into the number of sample and then remove kind of stuff. Yeah, but yeah, to keep it simple, okay, remove the largest winning trade in terms of the points and recalculate the profit factor. And again see that it is like, now if your overall profit is 2000 points and then all the 2000 points has come from May 19th, 2009 trade, you are obviously not making money in the rest of the trade. So your profit factor is almost more or less like 0 or 1, which is like, yeah, the strategy is not worth looking further. You also can calculate this maximum consecutive winners, which is like how many consecutive winners my trading strategy has given, or how many consecutive losers my trading strategy has given. You could calculate things like maximum drawdown and my compounded returns or average yearly returns and all this stuff. But as a starting step, I would at least look at them and then further go deeper. The last important factor, so even if you have done all this greater than 2.5 and then probably 70% winning trades and average profit expectation of about 0.5%, median trade expectation of about 0.5%, etc., like, and filtered out. The last one is which I take a little important. So this is like your student t-test, which you would have studied in your probably like 10+2 statistics. It's basically very simple. So we're adjusting for the total size of the sample on a multiplied by square root. So suppose if I made 100 trades, so I'm adjusting it for the square root of that. And I'm just taking the average and dividing it by the total the total trades standard deviation, which essentially means I would, yeah. Sorry, you have a question? No. And then so that is like square root into n, average of my trade samples minus average of the whole sample. So the whole sample is like, okay, if I'm testing from Jan 2000 to today, so that becomes my, you take the average, which is like 0.02 or 0.03% for Sensex, and then divide by standard deviation of your trade sample. Yeah, so let's say for a trading sample, I mean you have written some strategy and then you got like, let's say 20 or 25 trades. You would like to see this t-test to be at least more than 2 for a long strategy, and for the short strategy it becomes reverse, so it could be like less than -2. What it really means is if it is more than 2, your trading strategy is a little statistically significant and more or less all the trades are within the average, I mean plus or minus or in the average. So some of the clue, I mean whatever, like I'm trying to dig a little deeper into how I approach for the backtest. This is the simple format that I follow. So that's actually an interesting strategy, I think, which I'm presenting at the last, some at the end of the trading strategy. So that particular trading strategy has about 0.9% expectation with about 82% is winning trades. This is on Sensex from 2002 to date. This is what I was talking. So if you buy on any day and exit the next day on the Sensex, you get about 53.6 or let's say about 54% winning trades and about 0.1 or 0.05 average or 0.1 as a median. And your outlier adjusted profit factor, that is like for every $1 you lost, you would have made $1.09. And for a 2-day holding period, your average increases to 54. And then for a 5-day, again, it increases a little bit. It goes up to 56.8. And for a 20-day holding period, it increases to 59.1. What do you conclude by those numbers? And your average also increases like 0.5 for 1 day. And obviously, I mean, for 20 days, it would be like 20 into 0.5. That would be like 1.1 or whatever. I mean, for me, the thing is, I mean, the little longer that you hold, your trading chances increases and your profitability increases. Unless otherwise you have a very, very sophisticated high-frequency trading system, which is like trained to trade on a 1 minute or 5 minute time frame. I would prefer you to look for a little long term, like probably like 5-day holding period. That's where your profitability increases. And the last two items, the first positive and first negative exits. So these are like some of the various exit strategies that I employ. So the T+1 is basically, okay, I buy today, I exit after 1 day. That is T+1. T+2 is like I buy today and hold for 2 days and exit after 2 days after close. Whereas the first positive exit in 5 days. So this is like, I buy today, let's say the Sensex is at 8,200. And in the next 5 trading days, it could be tomorrow, it could be day after tomorrow, it could be up to 5 trading days. If it closes above 8,200 on any of those days, I exit. Otherwise, I exit at the end of the 5th day, which essentially means I am losing. So I exit with a loss. The same thing, the first negative exit. So this is a simple technique. So when you run a trading strategy, you are getting these numbers, right? The 54%. So obviously that means I am buying and I am selling. So if you run the same numbers, you also could get a lot of negatives, which essentially means you flip the trading strategy and make short, going short as a trading strategy, and again get those positive numbers. So that last number that I look sometimes gives me clues to, okay, this is, okay, if that number turns very positive, then I go short and cover whenever it closes lower in the next 5 days. Otherwise, I exit at the end of the 5th day for a loss. You could basically try with multiple other exit criteria, which I think I will just talk few other exit criteria, like let's say enter at today close and exit when the market closes below 5-day moving average, or any, I mean, you could experiment your exit strategies with moving averages or percentage drawdowns or so many other things. But yeah, so the simple thing to do is, okay, this is like very easy exit strategy. So I buy today and I exit tomorrow. So a lot of people, whoever talks on the dip buy or whatever in Indian markets, that's really not the case. As you can see here, the number earlier it was like 0.1, and now if you buy the close after Sensex moves up, like today it closed in green, So if you buy on that day and you exit the next day, your chances of like, I mean earlier it was like 53.5, now it is gone to 57. And your earlier average was like 0.1, now it is like 0.15. I mean, so that's how the Indian markets work, whereas again, this is just like my personal opinion. A lot of people may agree, may not agree. You need to have your trading strategy for, I mean, preferably you could have a trading strategy for each index. And that particular trading strategy may not work, or not necessarily that it should work on Bank Nifty. Let's say you wrote some code and then it's working perfectly fine on Nifty. Not necessarily it should work on Bank Nifty as well, because some of the people say, okay, the robustness comes from whether you develop a trading strategy and it should work across all the asset classes or instruments or various markets. But I haven't come across any trading strategy like that. So the simple thing is, the same trading strategy, if you apply on US markets, it works exactly reverse. So in US markets, buying a down day is profitable versus buying an up day in Indian markets. But anyway, so the lesson here is, yeah, so it's like, it makes sense for you to buy the Sensex after an up day rather than the down day. You can see, so if you buy on a down day, you are basically making loss, I mean, by holding it to the next day. So this could have come from 2008 or 2000 or I don't know, but that's been the overall figure. And even if you look at the median trades, so it just like, yeah, it's 0.01 minus %, so it doesn't make any sense. I mean, this is like buying on every down day and selling on the next day. So the lesson here is, I mean, if you are like looking at long only strategies, so go with the momentum, which is like try to put a filter like buying on an up day versus buying on a down day. Just to take it further, what I'm doing here is, I mean, this is like trying to introduce like a little different exit strategy. So I buy on the first up day, the Sensex, that is like today is the first up day. What it means is the previous day it could be down, it could be a series of downs, but yeah, today is the first day the Sensex is up. Something like you will see news, Sensex is up on first day after being down for 5 days or 2 days or whatever, like as if it's a big news. And I exit on the first down day. So I buy at the first up day and wait till it, yeah, like probably catch like 2 up days, 3 up days, 7 up days or whatever. So I go after that and I exit on the first down day. The Sensex returns from the 2000 January to till date is about 21,870, that's approximately, or like 22,000 points. Whereas this particular strategy would have returned you about 35,000 points. Of course, it doesn't have big winners because the idea here is like, yeah, you might catch like a big upswing, like probably when Sensex would have gone up by 10 days or 11 days, so you would have got all your gains. And those things happen once or twice in a year, so that's what this particular strategy is doing. And look at the down figure, which is like average win percentage, which is like 2.3 versus average loss, which is like 1.1. So that's where your advantage as well is coming, in spite of being the number of winners only 43%. Just to try these trading strategies with high leverage, that's where you go broke. So you cannot try these trading strategies with a high leverage or whatever, because you don't know what's your sequence of losses or sequence of it looks good on the paper, like okay, you are making a lot of money by by winning 43% of the trades, as opposed to whatever, like I was talking, like 60 or 70%. Yeah, but another point here is, yeah, you can still make money even if your percentage winners are any number like 43% or 40%. You will also actually see one more strategy where you are making money even like being right only 35% of the time. This is like another the momentum. So the one is, yeah, but you look at up day, down day, and the sequence of up days and sequence of down days. The next step that you could look is, okay, if the market is closing at end-day high, like it's closing at 5-day high, 10-day high, 20-day high, or 3-month high, which is like 62 days, or like 125, which is 6 months, 250, which is like 1 year. So if the market today is closing at 20-day high, which basically translates to a month, right? So if you buy on that day again, so if you buy on that day and again exit the next day, you make money, like about 60% of the time with an average of 0.2 percentage. If you are buying on a 20-day low, again, most of this damage could have come from 2008 and 2011 and few other years. But again, so buying the 20-day low is basically a loss-making strategy. And another observation which I haven't put here, when the market starts hitting either a 20-day high or a 20-day low, it actually makes series of them. So it doesn't switch from 20-day high to 20-day low or vice versa immediately. So the average number for a 20-day low, when it starts making one 20-day low, makes another, makes another, makes another, makes another, and then starts going up, and somewhere it starts making 20-day high. The series of this, the average for a Sensex stands at about 5 or 6. When you see the first 20-day low, don't jump and immediately go and buy. So 75% of the times you get another 20-day low. Average number of 20-day low it makes, the series is about 5, 5.5 or 6. The same thing is vice versa. The first 20-day high, for the people who always are itching to short, do not short the first 20-day high, because it keeps making a series of 20-day high. That number again is the same, so it keeps making like about 7 to 8 on an average. Another tweak that you could do is, okay, the changeover, this is like rate of change over n days. So if today is greater than yesterday, so you can say like ROC 1 is positive or whatever, and you can also say the number. So if the market is, if today's close is greater than 20 days back close, that's when your ROC, the rate of change of 20 becomes like positive. And if it is less than the close 20 days ago, it is basically the ROC 20 is negative. So the point here is again, so if you buy when the ROC, that's the rate of change, like 20 days ago, you are making money, as opposed to ROC 20 when it is negative. So when you buy and the market is like lower than 20 days ago, you are not making any money. So the lesson here is basically like you try to buy when you are trying to do, especially in the Indian markets, go with the momentum. So that's what is working in the last 14 or 15 years. I didn't actually put the point numbers here. So the points actually, so this is like you buy the first crossover above the rate of change, like when it crosses above 0 for the first time, and then you exit when the ROC 20 becomes the negative. So that's simple long only strategy. You have like 152 trades since Jan 2000. So you only made money on 38% of the trades, but your average for the trade is about 1.72. Look at one of the maximum trades. So that's where some of the humongous gains are coming, like 58.4% in one particular trade. And you are making money because that average win by average loss is by 7.3 divided by 1.7, which is like close to 4 or more than that. It's again, it continues. So these are like, so the ways to look is, okay, up day, down day, then where is the market? Is it a like 5-day high or 20-day high or 20-day low, 5-day low, and like look at in terms of the highest closings. And again, so most of this intraday high, or I basically prefer to use closing highs rather than the intraday highs or intraday low. So if the market ticks, like let's say if it intraday dips and then again settles at somewhere, try to use the close, which is that's where most of the people closely follow, not the intraday and intraday high or intraday low numbers. And then you basically could look at the percentage up days and percentage down days. This is just an example. So again, buying the 1% up day, which most of the people say, oh, the market is already up, let's wait for the pullback. That's not the case. So if you buy the 1% up day, like there were like about 830 trades or 829 to be precise, you are making money on 62 and a half as opposed to a random buy of about 53. So that's like 10% extra trades you are making winners. And you also get like about 0.31% as your average gains or whatever. Again, so the buying, especially this is like for the short-term trading, I'm not talking about the long-term investing. So if you are like trying to jump and let's say, okay, buy this dip, the market has fallen 1%, there was never like a winning strategy or anything. So it's just like, it doesn't even break even. So you are basically losing the money there. This is, how many people day trade here? And what's your definition for day trade? So it's like you don't want to carry the positions overnight. And that's when the market moves the most. If you buy on close and you are sleeping and again getting up in the morning and you try to exit market on open, you would have made about 65,000 points on Sensex as opposed to your 22,000 points on buy and hold. That's like 3 times the buy and hold returns. And you also look at the winners. So you have about 67% as winners just by buying for the close, that is buying at the market on close and then exiting on the market on open. That is like holding overnight. Sorry? Sorry? This is just the strategy. On every day I am buying on close and I am selling on tomorrow morning. Of course I do get gains, and I mean the maximum loss is about 7%. But again, so this is, if you had done this particular strategy since, most of the numbers that I am talking are like from January 2000. Now, if you buy on open and exit on close, you would have basically lost close to 40,000 points. That's an average of about 8 basis points or like 8.08% on every day. That's the amount that the market loses on an average. So the lesson from here is, I mean, preferably my trading strategy, which if I were to go long, I would definitely try to carry the position over the night rather than doing that in the intraday. Yeah.
How relevant is it to have this data from 2000 onwards till date? Would it be more relevant to have data that is about 5 years or 10 years?
You could, when you were testing your strategy, so these are like just giving an idea.
2000 is way back.
Yes.
So if you have a data which is more
Yes.
about 5 years or 10 years,
Correct.
would that be more accurate in terms of you understanding or being the
We'll come back to that later, because so I'm just trying to normalize, or whatever you call, from the data that we have, like from 2000 for all the trading strategies that we are talking.
market dynamics?
Yes, I know. I'll come back to that. I'll come back to that at the end of the session.
So Randy, if you consider that really somebody is buying in the evening and selling in the morning, what about the
I understand that. I understand that. No, I do understand that. I am talking about without the slippage, and especially there is no market on open order in India because you won't get. But what I am telling is whatever the open and whatever the close.
So it is just the difference between close and next day's open what you have put up.
Sorry?
What you have put up here is just close of the previous day and the opening of the next day. Whatever is the net difference.
Correct. Sorry, what? Yeah, it is that. Yeah, that is the. So I mean, if you buy on close and exit on next open.
Not buy and close. If you really trade it, there are going to be slippages.
For every trading strategy, there is a slippage.
That is true.
Yes.
But when you are taking the delivery in the previous day and selling it the next,
It's impossible unless I mean I know that this is like impossible. You don't have like a big hedge fund money. The thing is, you don't be afraid to take the long positions in the night because that's what your statistics are favoring. These are like some other various like price action or price patterns that you, I mean I'm just giving you hints. So you could basically take the range of the day which is like high and low and mark where your open or where your close is. And this is a simple formula like open minus low and divide by high minus low. That gives you where the open is. And the similar thing, but on a close minus open. Sorry, that's not close minus open, that's close minus low. But anyway, so that's how you calculate where your opens position and where your close position is. And then make that as like some percentage number. And yeah, you could develop trading strategies like let's say if my close is in the top half or top 10%, top 20%, or bottom 10% or bottom 20%, then what's going to happen onto the next day or whatever. And typically you would hear something called trend day. That's where your market opens on the bottom side of the range and then rallies and then settles somewhere on the top. That's like trend buy day. The reverse is the market opens on a high point of the day and then starts getting sold off. That is like trend sell day. You could put your own numbers, like I prefer like 20% range. And if you like reduce like 5% and 10%, it's a little difficult to get the trading strategy in the live because the close that you see at 330 versus like 335 or whatever varies little bit. So don't use like very small numbers like 5%, 10%, so use like 20%. Even that would sometimes go for a toss. And these are like your close, you can play with your, if the close is above the previous day high, you could basically use that as your as input to your trading strategies. Similarly, the close, if it is below previous day low, that your close could be below previous day close, but again sometimes it goes and closes below yesterday's low. And I have like these are the few other gap up closes or full gap up closes, which is basically the gap up close is today's low is greater than yesterday's close, whereas full gap up close, I mean like today's low is greater than yesterday's high. That's like you will see those on the charts or whatever, like gaps going up. So that's full gap up close, full gap down. So most of, again, the thing is quite a few people have this notion that okay, the full gap up close, okay, it will fill some other day. I mean, quite a few of them gets filled. But yeah, that's one of the favorite people talk about that gaps needs to be filled. I didn't do anything, yeah. Yeah, let's go on. Short this full gap up or even the same thing full gap down close. But most of the times in Indian markets, at least in the short term, like in the next 1 or few days, they continue. I mean, just because the market has like opened a gap up or gap down, don't go on short or don't go on buy thinking that it will get filled immediately. Again, so you also could take, let's say your event could be anything, like let's say 200-day moving average crossover, or like let's say today is the first percentage up day, or first percentage 1% is up day or 1% down day. You could calculate the time factor. Okay, when was the last time this particular instant has occurred? Like let's say the recent DMA breakdown, the 200-day DMA breakdown on when was that? 24th April. So that was like happening after 382 days. So you could use the time that is passing between the events, like the last time the market closed below 200-day moving average was like about 382 days. So just use that. Okay, what if from my event, this current event to the prior event, what was the time elapsed? So how many trading days? So you could use greater than 10 days or greater than 20 days as your input to the trading system. And again, I'm sure like quite a few people would have heard this inside days and outside days, which are basically the inside days, today's the whole high and low are like within yesterday's high and low. The outside day is exactly the opposite of that. And this is like, again, take range as an input. So this is like today's range is basically the high and low, high minus low, and compare it with previous day. So that just becomes like narrow range. If you compare with like 4 days or 10 days or whatever, that becomes like NR7, NR4, or like the opposite of that is like wide range day. So, and again, so you could take wicks as an input, but again, so use, especially when the divergence happens. So what I mean by the divergence is, there are certain days when the market is up, but the wicks is, normally it is down, right? When the market is up, wicks is down. On certain days, both wicks and market is up, or vice versa. I mean, both wicks and market are up. So those are like the little divergences. You also expect when Nifty is trading at 5-day high, your wicks to be at approximately or somewhere around 5-day low. But again, that could be on 5-day high for some reason. So those are the divergences that you could take. Otherwise, it gives you the same information. Let's say if Nifty is down by 2%, obviously my wicks would have gone up by 10%. So there's no point in looking. It's the same information. So you look for little divergences while trying to develop your models. And also you could, let's say if today's gain is like 1%, sometimes it just, I won't say meaningless, but yeah, meaningless. Okay, let's say yesterday is 5% up day, and today is like 1% up day. It's like a small move, right? So you could compare today's percentage move over the previous 5 days or 10 days, and then you could again try to develop the models. So the thing here is, if the Nifty hits the best move in 1 year, all right, so today is the best gaining day in the last 1 year, which is like last 250 days, Nifty generally continues, and that continuation is happening for the last 42 trades, if I remember. So whenever like you hear Nifty is making like the best move in the last 1 year, I would suggest you go and buy, because it has like 0.6 or 0.7% edge for just 1 day holding period. You also could take the seasonals as inputs, like day of the week, like Mondays and Tuesdays, because each day they behave differently. And also the trading day wise, just to, and most of the, I don't know how many of the people you know, but the first day of the month is the most bullish, and then it starts dropping, and again the bullishness increases as we enter into the month end. And again the same, like trading week wise, like the first week or second week, or like is it the OPEX week, or is it post OPEX week, or pre OPEX week, or first week of the month, things like that. And some of the special days is like any of the economic events, like RBI events or the Fed meeting in US, and the first day of the month. That's what I use a short form, like one down. The OPEX is basically the option expiry. And then like try to see various months. You could also use a filter like, okay, if current month is April, is my strategy is going to behave like differently or not? And then you could basically keep searching on the net. So that is one of the particular aggregator which I like, because they take the material from 100 and plus sites and then they keep feeding you the information. So whatever they publish, right? So you could, if you could able to test, you go and test. So you might get some new ideas, and that's the quantocracy. And another way to get some of the ideas is like search whatever you have in your mind, SR and plus, you put that thing and then you will get something back on the Google. And that's another website which I follow a lot, where you get, I mean nowadays we talk a lot of other matters, but yeah, like 5 years back they were like talking mostly on the markets and then the trading by numbers, or like it's mostly the quantified, but nowadays it's on various topics. But still I would suggest you keep checking that website, which just gets updated every day. And that's how you basically try to get your, I mean at least as a simple, now if you keep trying the variations, right, so that's where you are like, so if you just take whatever we spoke, that will become like 20 rows on an Excel sheet. And now 2 power 20 is, how much is 2 power 20? That's about 1 million combinations is what you were trying, just like by taking your filter and checking what's happening. And you add like one more parameter, so that's, I mean like that's how you basically get your trading strategies all about. Like, yeah, look for something and filter and then keep, it's like, yeah, I mean like, yeah, if you just put like 20 rows, that's like 1 million combination, and you put like another 10 rows, you've gone like 1 billion or whatever. I'm done in the first. If you just remember the rules which I have written in the last, I just reverse them exactly in the symmetrical fashion. So close is less than 200-day moving average, current close is 20-day low as opposed to 20-day high, and the change is greater than 1%. So here I am talking change is greater than 1%. If you ever get a trading strategy which is like the symmetrical in nature, like you write some rules and you reverse the rules, and if both of them are profitable, you deploy them in the live immediately, because that's very rare. I won't say very rare, but it's, you need to work a lot to get trading patterns which are like works very symmetrically. So here you go short, you make money. So that is like 30% of the times you are losing, which essentially means 70% of the times you are winning if you had gone short when that happened and covered on Monday's close or the next trading close. This is what like I was telling, right? The full gap up close, like let's say, oh, the market has left a gap up, the gap will be closed, let me short it. So don't do that. That's what I'm trying to say here. So you basically like 65% of the times the market is up again next day, whenever it leaves a open gap, right? And the average is like 0.34%, which is like little higher end. I won't consider to go along with this trading strategy. What it means is I don't want to short. That's thinking that, oh, the theory is, okay, this gap is going to get filled. These are some of the sequences which are running since 2000. So I just like added a parameter, like today it is a full gap up close and yesterday was an inside day. So sequence is running, but I don't know when it's going to stop. So you have like 28 of 28 winning trades since 2000. Of course, I won't say the trade size is low, but because like we're using an inside day, which happens only 10% of the times in a year, and full gap up day again, that again happens only 10% of the times. This is some of this the seasonal or like the usage of OPEX. So that is like tomorrow is OPEX, that is the option expiry, and we are like above 200 DMA. Like now, yeah, like we are like trading like below 200 DMA for the last 5 days or whatever. But yeah, so this, and that is mostly this is like Wednesday, so that OPEX is on Thursday, right? The last Thursday. Just look if it is a close is up on a Wednesday, you go long and you hold for about like 5 days. Look at T+5 column. So that is like about 1.7% with about close to 80% winning trades. This is like go long if the day before OPEX is green and the market is above. So you and hold for 5 days. So I don't know when this is going to stop, but this is working since 96 or 97. So just this is like Christmas rally or whatever people talk. It's just go long on before the Christmas day and then exit after whatever, like 5 days. So you had only one loss-making trade. Again, this is like your March 31st trade. So if you go long on March 31st or the last trading day of the financial year, need not be 31st March, but whatever is the last day, again you make money about, I mean, I'm just looking at the T+T, like you had only 2 losing trades. But again, you had like one very, very big losing trade, but that happens. Yeah, I mean, that's like I try to give you like how I look for the patterns and then like try to get something at the end. This is my email ID. I mean, you can write anytime. If I have time, I basically take the time and try to reply. And any questions, you could. Hi.
Thank you. Thank you for the wonderful session. I had a question about standard deviation. I use a few trend following strategies. So what happens with trend following is that you let the winners run and the losses are limited.
Correct.
So the profits are much larger than the losses. So standard deviation usually punishes those kind of strategies because the standard deviation tends to be higher. So for those kind of strategies, what kind of risk parameters should we use? Was I audible?
Yes.
Okay.
I mean, some of the time, I mean, the standard deviation per se, it's not a very, what I would call as a robust measure. So you just take 10 samples, right? I mean, 10 trade sample. And then, let's say, you are adding 11th trading strategy. Let's just put 0 and look at the standard deviation. And just put for the fun like plus 100%. I'm sure like plus 100% is not going to happen. Just see the variation from the earlier number to this number, right? So just 1 or 2 trades could influence a lot on this particular number. So in which case basically some of the other statistic is like your inter quartile range or whatever. So now you have like these 100 trades, right? So this is the bottom, top 25 trades, bottom 25 trades. Just get into the middle 25 trades and then see the range. And then see if that makes sense for you to deploy your trading strategy on the live. But again, as I said, for most of the trend following strategies, it is like 1 or 2, those big trends, which actually makes. So if you're looking
that will be in the top quartile, right? The major winning trades will be in the top quartile. So
yeah, so you are removing them and you are removing the bottom. So you are basically getting into the mid quartile.
Okay.
So that is like removing 37.5 and 37.5 at the bottom.
Okay.
And then see whether that particular range is, like whether it suits you to deploy the trading strategy on the live.
Okay, cool. Thank you.
Could you please explain again the OPEX strategy that you showed?
That's tomorrow is OPEX.
No, just,
Yeah, I'm telling you the rules. The tomorrow is OPEX.
okay.
That means today is either Wednesday or the day before OPEX. I mean, if it's a holiday. And market is above 200-day moving average. And today is up. Like the day before option expiry day, it is up. So you buy and hold for 5 days. Sorry? The downtrend is not so profitable, so don't try that. I mean, so the first strategy is, I mean, I'm just telling, the first strategy I picked up because that's how you need to develop any trading strategy. I mean, if you get like a symmetrical trading strategy, you have something very good in the market, because most of this stop and reverse and these systems, right, they don't really work well on both the sides, right? I mean, so if you, let's say 100 trades, you would have definitely made 50 long trades and 50 short trades, or maybe in a little different composition, but the profits that you get is like very skewed. Whereas in that particular strategy, it's like almost like, I won't say they are exactly same, but they're close enough. So if you can develop a trading strategy, yeah, I mean, or try to develop a trading strategy like that. OPEX trading strategy is not a trading strategy like that. What exactly we're trying to do there is, especially being in India, the OPEX comes at the last Thursday, right, which is basically closer into the first day of the month. So you are basically getting that bullish tendency of the first few days, or last few days of the month end and first few days of the month end. That's where the market move happens a lot. I mean, from seasonal perspective, that is what you are buying into in that my OPEX trading strategy.
Hi Kora, Vishal here. I have seen a lot of, in your presentation, there are t-tests that you have used.
Correct.
Can you just help us to elaborate in what is the significance of t-tests that you have used in all your presentation?
So I told you, right, so I generally look at two, for a trade sample of 25, I look at a t-test of more than 2. It actually means, so if you put that numbers and calculates your something called p-value after that, so you get some number, which is, in this case, you will get a number which is less than, much less than 0.05, which essentially means none of those 25 trading strategies have occurred by luck. There is some significance which is going on. So if you get like that p-value like 0.1 or 0.5 or whatever, right, so that means there is some luck, or they are not statistically significant. So as a thumb rule, I use like 2 for 25.
When to come ahead? And let's take the last question, please, because we are already over time.
For the testing, back testing, do you use TradeStation or such kind of tool, software, which will be easier for doing back testing?
You can use, but so for some of these trading strategies, we try to develop them in Excel because it's, for us it's easy to observe, and then we deploy in our own custom software which is written in Python and R. The reason that we don't go into this TradeStation and all this stuff is, as I told you, right, that 2 power 10 or 2 power 20, we could actually go up to 2 power 50. Your TradeStation is not going to run on over these PCs, so you need a big cluster or whatever. So for that, that's the reason we exactly,
So
we
it's
write
like
our custom.
customized software you're using?
It's like, yeah, we keep developing that. So we use Python as a core.
Okay, thank you.
I mean, the Excel is going to break after I put like 25 rows, but again, I want to extend. So, but Excel gives me like little easy for me just to visualize and everything in the initial snapshot. Yeah. We actually can talk, I mean, anybody, I mean, just for the others' benefit or whatever, I'm like, let's wind up the session, but yeah, I'm here for half an hour more or whatever. Thank you.